Here is the bottom line on how retail is doing. Luxury stores like Tiffany are in great shape, and so are the so-called dollar stores, the bargain chains. It's the retailers in the middle who are struggling. Milton Pedraza is the CEO of the Luxury Institute. He's here with us this morning. We're glad to have you with us, Milton. Richard Hastings is also joining us. He's a macro and consumer strategist at Global Hunter Securities. He is going to be with us from Charlotte, North Carolina. And of course, Hitha, right beside me here in the newsroom, our retail specialist. Milton, we'll start with you because you're right next to Hitha and myself. How can you explain this? I mean, we talk all the time about a slowdown in consumer spending, about 9% national unemployment, and yet we've seen numbers. Hitha's been filling us in along this earnings pattern. Coach, Tiffany, all these brands knocking it out of the park.
Hermes today, even.
Yeah, that's right.
Yes, I think there's a very significant segment of the population. Most people don't know that the top 20% of customers of a luxury brand make up 70% of the sales. And that 20% is paying full price. They're very income wealthy, if not asset wealthy. And there was a lot of pent-up demand.
They have to have cash in their pocket. I mean, we were talking yesterday from Tiffany, something like this range of $20,000 to $50,000 products. It's not just the $125 tourist necklace.
Correct.
It's actually some pretty big, I don't know, you have to have cash in your pocket to be willing to drop 50 grand on a necklace.
And there's been a lot of pent-up demand over the last few years that now is being met. And also there is a lot of cash out there. And frankly, a lot of people don't know what to do with their cash except to maybe spend. And there's a great opportunity right now.
But Milton, can you address for a second how these stocks are tied to the market? We have a graph over here that I just wanted to reference for a second. For example, okay, you see the Dow here, right? Yes. At the highest point, Tiffany, Coach, and Saks Fifth Avenue were doing, fairly well. Now, you look at their lowest point here during the recession. Saks Fifth Avenue is at $1.79, Coach is at $11.74, Tiffany $17.33. Now, cut to the highest point again. Look at how these stocks are doing. How even Steve Sadoff said that Saks Fifth Avenue is tied directly to the market.
Yes.
So, what does that mean for the luxury consumer going forward?
Well, luxury has always been cyclical. But luxury always dramatically underperforms in recessions, and it starts to lead and then outperforms in recoveries and, of course, in peaks. So I think what remains to be seen is whether we're going to have a significant decline in the stock market, as Steve Sadoff would say, and that will affect luxury.
Richard, we want to bring you in here because you're following a different angle of this retail space. I mean, where is the strength coming from? If we've heard why we're seeing luxury hold up, why is the other end holding up?
Well, let's talk about the lower end. Is an unbelievable population. 68% of households in the United States have household income below $75,000 a year. Half of the households in the country have income below $50,000. And then once you start to go into Walmart, Dollar Tree, Family Dollar, Big Lots, Dollar General, and analyze the demographics of the shoppers, you're talking about pretty big percentages of those shoppers that have household income, believe it or not, below $35,000 a year. Dollar Tree, the average income based on our estimates from big research shopper surveys, $27,000 a year is the average income of some of these Dollar Tree customers, and yet look at the growth horizon of the business is unending. And if you match up the demographic description of the dollar store's customer with what you've got over at Walmart, which is $260 billion in sales based on Walmart North America USA, excluding Sam's Club, that means that you've got an enormous amount of these people available for the dollar stores to continue growth. So it's not just about economics. There's a demographic analysis that says that the dollar store's growth horizon is going to continue to be strong for, unfortunately, bad reasons.
Richard, so let's talk about that. I was just looking at Dollar General, excuse me, their earnings yesterday. Beat analyst expectations. What does that mean for the consumer going forward then? Are we really are we to expect a recession? Is that sort of on the horizon there?
Recently, we were very concerned that we would be at near recessionary characteristics in early 2012. We're starting to get a little bit more positive. We're starting to see that some of the indicators are not deteriorating as we expected. So we're getting a little bit more bullish cautiously about Q1 2012. What we're seeing with the outlook for construction and the storm damage is that all of the storm-related damage from the tornadoes and now Hurricane Irene, that's very good for hourly employment in construction-related jobs, and that's a little bit of a positive. So that's a helpful sign as well. So we're not expecting recessionary characteristics anytime really soon, and that's not the reason why the dollar stores continue to do so well.
Richard, if you had to pick a best in brand for the demographic that you're talking about, what would it be?
Well, we don't cover the stocks in the sector, so I'm not going to really give a pick based on that. I would say that there's some interesting things to look at. Just go to the Dollar General website, dollargeneral.com. It doesn't look like a dollar store at all. It's national brands. It really looks like Walmart. Then if you go into Dollar Tree and you start to analyze some of the business there's a lot of back to school, a lot of office supplies. Also, there's a slightly different mix of shoppers where there are some higher income shoppers in the Dollar Tree business. So they're a little more complex than we think. And also, Dollar Tree's online business from its institutional sales is actually pretty interesting based on estimates of traffic to dollartree.com, looking at unique visitors every month over a long period of time. Dollar General also pretty big traffic to the website.
Milton, I don't want to get a stock pick. That's not actually what I meant to ask Richard. I'm just talking about the brands. You know, if you had to pick a best-in-breed brand in the luxury area, what would you pick? Who's executing the best? Who's offering the most interesting products for the people who do have money to spend? Pretty big ticket.
I would say that in accessories and fashion, it's Bottega Veneta and Hermes are probably the top two brands. Gucci, Louis Vuitton are doing extremely well.
Those Kelly bags are flying off the shelves, apparently.
They are. The same thing with Bottega. I just think that if you are a quality brand with a lot of heritage, you're going to do extremely well. Tiffany, look at Tiffany Jewelry. It just seems to be relentless. So as long as it's a top-tier brand, they're doing extremely well. If they're sort of also-ran brands in luxury, then they're probably going to soften up.
They're missing out.
Yes.
Milton, we thank you so much. Milton Pedraza joining us, the CEO of the Luxury Institute. Richard Hastings as well. He's a macro and consumer strategist from Global Hunter Securities, joining us there remote.